In 1954, at just 10 years old, Peter Lynch lost his father and the main source of his family's income due to cancer. This forced his mother to return to work in order to support the family, and Peter himself, despite his young age, began working as a caddy. Little did he imagine how this job would alter the course of his life and lead him to become the greatest money manager in history. This is his story and his advice for investing successfully. As a caddy, Peter Lynch would overhear millionaires talking about the stock market all the time, during a period when most people viewed stock investments with skepticism due to having grown up during the Great Depression. However, the success of the individuals Lynch assisted while they played golf made him question these beliefs and start to develop a positive image of the stock market. He believed that he too could make a lot of money in this realm, much like other famous investors did at an early age. And one of the individuals he assisted would end up becoming one of his mentors, George Sullivan, the president of Fidelity Investments, one of the largest and most important investment funds in the world. Thanks to George Sullivan's influence, Lynch was able to attend Boston University and continue his studies at Wharton, where he would earn an MBA. However, during his time at university, it wasn't the finance, management, or economics classes that would shape the mind of one of history's brightest investors. Instead, it was classes in psychology, philosophy, history, and political science that would greatly shape his way of thinking and how he viewed the world. This is something he is not alone in, as other legendary investors like Warren Buffett and Charlie Munger have shared similar sentiments, criticizing academia and how universities teach investing.
I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows. They push them on usual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. It's not a negative.
Peter Lynch does not share the common opinion that small investors with limited funds cannot compete with professionals due to lack of information or tools. He has always championed the idea that an average person holds a significant advantage over Wall Street professionals. And he has been able to support this idea through his own experiences as the manager of the Fidelity Magellan Fund, which he took over in 1977 after starting to work at the company in 1966 as an intern due to his relationship with George Sullivan. Although at the time of his arrival, this fund managed only $18 million, when Lynch decided to retire in 1990 to spend more time with his family and prevent his children from growing up without a father like him, the fund had grown to manage $14 billion and had accumulated an average annual return of 29.2%, the best performance in history for a fund over such a long period. When Peter Lynch began managing this fund, the industry was undergoing radical changes and shifting its focus towards marketing, preferring moderate returns on a large sum of money rather than high returns on a smaller sum. This was reflected in the way investors from these institutions were behaving, passing up significant opportunities in favor of always playing it safe to ensure job security. Furthermore, Peter Lynch observed that rules regarding diversification, allowable percentages of a single stock, the types of stocks that could be purchased, and other regulations imposed by the SEC limited professionals but not small investors or small funds like his own. Moreover, according to Lynch, all individuals have the capacity to see potential investments in the things they consume and the services they use, much before these come under the radar of professionals who only pay attention to large and established companies. This provides a significant advantage to small investors. Not everyone is prepared for the stock market, and Peter Lynch has a very clear stance on this matter, along with some recommendations for individuals before they start investing. The first recommendation is to ensure that the invested money won't be needed in the short term. This means that the invested money can be lost without affecting the investor's quality of life and can be left in the market for several years without needing to sell. According to Lynch, it's very difficult to predict whether the market will be at a higher level in 1 or 2 years, and when someone invests with the hope of making more money in such a short time frame, they run the risk of the opposite happening, with their investment temporarily declining due to market volatility. That's why, if your plan is to buy a house, pursue further education, or pay for your children's university education in just a few years, according to Lynch, the stock market isn't the best place to put your money. And if you want to compete on an equal footing with the large funds, you have to avoid putting yourself in a position where you're forced to sell your stocks for personal expenses. Finding appealing products and services is not enough. It's important to conduct research on the company producing them to determine if it's a good investment or not. A key element of this research is determining whether the stock is priced high. According to Lynch, high prices can be determined based on the company's earnings and a simple ratio such as the price-to-earnings ratio, which divides the stock price by the net earnings per share. This ratio provides a rough estimate and, if earnings remain constant, it indicates how long it will take an investor to recover their investment. Lynch considers the interpretation of this ratio to be fundamental. The higher the ratio, the more expensive the stock. However, to determine whether a stock has high or low prices, this indicator should be compared to the company's annual growth. If a company is growing at 30% annually and its P/E ratio is 20, then the company's stock is attractive. If the P/E ratio is 50 and the company is growing at 30%, then the stock is considered to be highly priced. Small investors can make a lot of money by investing in overlooked companies. Stocks that are outside of the indices and have few analysts covering them can present great investment opportunities. Although they obviously come with higher risk, stocks that perform well have the potential to reward investors for those that don't. If you have 4 stocks and 3 of them lose half their value, but the 4th stock multiplies by 4, the investor will have gained a profit of 37% despite being wrong in 3 out of the 4 investments made. Peter Lynch also recommends looking in industries that others avoid due to finding their activities unpleasant. Companies related to cigarettes, funeral homes, and solid waste management are examples of sectors where he has found significant opportunities that most professionals hesitate to recommend to their clients. In fact, professionals prefer recommending well-known companies and reliable methods like diversification because no one jeopardizes their job by doing so. However, a small investor aiming for good results must avoid diversifying for the sake of diversification at all costs. And by diversification, Peter Lynch isn't referring to a specific number of stocks. In fact, he sometimes held over 400 stocks in his portfolio simultaneously. Instead, he means not buying a stock solely because it belongs to an industry you haven't invested in before. In such cases, it's better to simply invest in an index fund and gain exposure to the entire economy with minimal effort and transaction costs.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold.
Peter Lynch advises that you develop a story for your investments and clearly define the reasons for buying a stock and what you expect from the company. Understand thoroughly if the stock's price is reasonable, if it has growth potential, how competition and technological developments might affect it, how it would fare during an economic crisis, and how its management is performing. When a company's management focuses on rewarding shareholders through consistent dividend increases and stock buybacks, it's an excellent sign. It's also a positive indicator if executives are buying company stock or at least not selling off most of their positions. All these characteristics allow you to create a narrative that explains why you're buying a stock. As long as that narrative holds true, it's a good idea to hold onto the stock regardless of its fluctuations. Similarly, when selling, investors should avoid setting a target percentage for profit or a percentage of loss they are willing to bear. Selling should only happen when the narrative that prompted the purchase changes. However, if expectations deteriorate, the price becomes unreasonably high, the company struggles to maintain its business model during growth, or the initially acquired information turns out to be different, then it's time to sell that stock.
Obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whenever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're going to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
While it can be assumed that the market will be higher in the next decades than it is currently, it's impossible to know with certainty what will happen in the short term. Lynch is clear that long-term investors shouldn't attempt to forecast economic cycles or short-term market movements. Instead, they should focus on finding great businesses at reasonable prices. Investments in good companies will take care of themselves during challenging economic times, the timing and duration of which are impossible to determine.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
Lastly, but certainly not least, avoid investing in what you don't understand. Considering all the previous advice, seek to invest in things that you understand better as a consumer, customer, or due to your industry expertise. It's important to consider all the aforementioned points because enjoying a good cup of coffee, a tasty burger, or a quality product doesn't automatically mean that buying shares in that company is a good idea. Many factors must be taken into account. Peter Lynch's valuable teachings often get blurred into merely investing in companies producing products that we enjoy as consumers. However, it's crucial to look much further beyond that. Similarly, the astronomical profits that technology companies tend to generate attract many investors, even if they don't understand these investments and end up losing their money. Peter Lynch finds this as one of the silliest aspects of the stock market, that investors can't stand to see others making money in an investment or achieving better results than them. But allowing envy to drive decisions is one of the unfortunate factors that lead to a situation where, although everyone has the potential to succeed in the stock market, only a few actually achieve that success. If you enjoyed this video and want to support the channel, please share this content to reach more people who can benefit from learning about the life of this great investor. And you might want to see the biography of Warren Buffett next.